Welcome back. Now, slight decreases in output from 8 of its mines, paired with higher costs, have weighed on Goldfields. The miner has produced a 21% decline in annual headline earnings, but has raised production forecasts by a fifth for this year as it looks to kick off production at its Salares Norte mine in Chile in April. Company CEO Mike Fraser joins us with a closer look at the group's performance and strategic moves in Chile and South Africa. Mike, a pleasure. Good afternoon to you.
Hi, good afternoon, Olutanda. Pleasure to chat with you today.
Thank you so much for joining us, Mike. Let's maybe start off with the top line here. We know gold prices were quite strong over the period, but currency fluctuations are a completely different story. How has that fed into that top line?
Yeah, so what we've been really benefited from, with strong tailwinds from strong gold price, as you've indicated. Gold price averaged $1,942 over the full year, and that was really supportive for us. That resulted in a 5% increase in normalized earnings for the business and generated free cash flow of just a touch over $1 billion. And that really is quite significant if you think about the history and the past in the gold industry. So we really are living in good times for the gold sector.
And of course, we did see headline earnings falling there by just around a fifth. Let's talk about that and what that meant. Was that an expense issue, managing that, and maybe the mining inflation that you saw over the period?
Yes, I think there were two drivers to that. I mean, firstly, cost inflation, as you rightly seen, has been a challenge for us across the industry, in particular in Australia, which accounts for around 45% of our production. We operate in an environment where you've got, past full employment. Unemployment is running at below 4%. So really costs are something that we are suffering quite a bit on inflationary environment. And that cuts across the board. It's consumables, it's contractors, it's our own labor. And that definitely has had an inflationary push. I think the second thing that's, last year was a particularly big capital year for us, and this year will be another big capital year of deployment. And that all feeds into our overall all-in cost for the company, and that certainly puts a bit of pressure on us. I think if you also look at our production profile, and whilst we won't see that fully benefiting us this year, but the other point is the dilutionary impact of higher production, and we didn't see the full impact of Salares Norte and coming through, and that was flagged a long time ago, and we will see some of Salares Norte coming in this year, but more likely close to the full ramp up into 2025, and we should start seeing the benefit of that dilution coming through as well.
I actually want to touch on that Salares Norte. It's been quite a project, and I'm just keen to get your thoughts there on from an investment perspective, and just that guidance now that, of course, has gone upward. Mike, how you are feeling about the prospects?
Yeah, and I think one thing that I'm fully acknowledged is that the market was surprised by the delay announcement that we announced at the end of December, and as we all know, that surprises are never comfortable things for the markets as well as for us. And what I have done and what we have done is introduced an independent review of our schedule, and that was broken down into two phases. Firstly, looking at the completion phase and commissioning phase, and the second one was the ramp-up phase to full production. And we've completed the first phase of that, and we've got a lot of confidence that that is now a project that will be delivered on schedule and on time. One of the highlights for us was the first production of filtered dry stack tailings on the 15th of February, and that's quite important because that's an indicator that our circuit is working. The second one is our first gold, which is still scheduled for April. And so from our point of view, I'm very confident that we will be on track to deliver the production guidance, and that's the real value. This is a world-class mine, low cost, and will provide a lot of dilution to our cost structures.
Also keen to get some insights on the Africa operations, Ghana and South Africa. How have those fared over the period?
Yes, so Ghana, tragically, they had 2 fatalities in the year. That was the big disappointment around their performance, and we working hard to recover from that. We have also undertaken a global independent review on our overall safety system of work. But aside from that, if we can say aside from that, the production-wise, they delivered on their commitments and on their plan, which was a good outcome. The key focus is obviously demand and how we deal with demand going forward, given that's coming to end of life. But secondly, also looking at the Tarkwa Iduprem JV, which presents the opportunity of creating one of Africa's largest gold companies. Coming to South Africa, South Deep in the year produced over $200 million of free cash flow. And if we think about where that asset has come from and the challenges of its history, it's a really great outcome. I've visited that site 3 times now in the 6 weeks that I've been with Gold Fields, and I can just say that that's a world-class asset. And, not just Gold Fields, but any miner will probably be proud to have it in its portfolio. And looking forward to continue to see that business contribute and achieving its potential.
And casting our eye ahead, Mike, keen to get your thoughts here. I'm wondering, it's very hard to peg commodity prices, but where are you seeing the gold price go? And as we start to speak about interest rate cuts, what that might mean for that gold price and even Gold Fields as a whole.
Yeah, and I think there's a couple of unique tensions, there's almost been a slight disconnect with some of the traditional theory about what drives gold price. What's been quite clear in the past is that gold has been seen in the recent past as a way of hedging against inflation, and inflationary impacts have been quite severe because of the impacts of the loosening of fiscal purses since COVID. As you see interest rates coming off, I think there's a real fear that inflation remains sticky, which will be supportive of gold price. But the other thing that's been really supportive in the last 12 months in particular is strong central bank buying, particularly out of maybe the non-Western regions. And I think that also has a tie into potentially a reduced reliance in time, or a desire to reduce reliance in time on US dollar-based securities or foreign reserves. So there are certainly arguments to be made about a strong support base for gold for longer. But I will tell you, as the CEO of a business, that we would not just plan for that, and we plan based on consensus, and our business plan is based on a sensible way of projecting and preserving value for all of our shareholders.
Brilliant, Mike. Well, it's been a pleasure speaking to you. Thank you so much for chatting to us today. And that was Mike Fraser, CEO of Gold Fields.